Welcome to Spreadsheet Geek. In this video, we'll cover the finance concept known as internal rate of return. We'll define internal rate of return, put it into context, and talk about the Excel functions that relate to this finance measure. This video was made using Microsoft Excel 2019. Internal rate of return is usually associated with some sort of investment or project. We have predicted that based on our expenditure of $10,000 in this project A, that over the following years we will have these cash inflows. Now, we could evaluate this project on the basis of net present value. Internal rate of return is another way, or it's an alternative to net present value. Think of internal rate of return this way. Internal rate of return is the discount rate for these cash flows that's implied that would get us back to zero net present value. Let's look at a formal definition. Internal rate of return is the rate of return that equates the present value of future cash flows with the cost of the investment. We could set up our net present value problem like this algebraically and solve for internal rate of return. Notice on the left side of the equation, I've set our investment cost equal to all the present values of those future cash flows. Obviously, this would require some pretty heavy algebra. Excel's internal rate of return function will do it all for us. Internal rate of return provides a single number we can use to evaluate our project and compare it to others. And if the discount rate appropriate for the risk level of this project is less than the internal rate of return implied by these cash flows, then we should accept the project. Let's calculate the internal rate of return of this project using the IRR function. The syntax is very simple. You just list your values, and then you get an opportunity to make a guess. Now, the reason they do this is because in some sequences of cash flows, you might go from negatives to positives to negatives or vice versa, and you have two changes of sign. When you only have one change of sign and the first number is negative, you don't really need to guess because there's only one internal rate of return that can solve the equation. If you have two or more changes in signs, there are multiple internal rates of return, and this IRR function always returns the first one it arrives at. So entering a guess can help guide it in the right direction. I'm just going to enter 13%. And I got 12.0%. If you take this out a few decimal places, it's not as pretty a number, but we'll just say it's 12.0%. Now, to verify this internal rate of return, I'm going to calculate the net present value of these cash flows using this discount rate. If internal rate of return and net present value match up and are computed the same way, I should get to a net present value of 0. Let's try that. Using the net present value function, I'm going to enter this 12% as my rate and list my values. We should get to 0, which we do. Let's format that. Now, as a quick little second check that I'm not going to spend a lot of time on, I calculated net present value the manual way just to make sure that that also matches up with my net present value function. This is probably a good time to mention that the IRR function in Excel assumes that any positive cash flows received earn interest, so to speak, at the IRR rate for the remainder of the investment period. This is very similar to net present value. The difference being that with IRR, that rate is computed internally, and with net present value, you go in there and state whatever rate you want. but net present value operates the same way. And the proof of that is that when we apply this rate in the net present value function, we get to 0 net present value. Now let's add a second project, this project B. And let's say these are mutually exclusive projects, meaning that we only have enough capital to invest in one of them. It's one or the other. So which one should we choose? This is a good opportunity to just autofill this over. And you can see that the internal rate of return of project A is higher than the internal rate of return of project B. That would indicate project A is the one we should choose. However, let's do a little net present value function using an appropriate discount rate for both of these projects and see if the results match. Let's say in our example here that an appropriate discount rate for either of these projects is 10%. So we'll calculate the net present value using that rate and see if our net present value analysis works the same way as our internal rate of return analysis. And you can see that if I pull this over and autofill it in, yes, project A looks more attractive on an internal rate of return basis as well as a net present value basis. To illustrate some of the problems with Excel's internal rate of return function, I'm going to show some other examples. This third project is one where we receive cash up front and then pay it out over the other 2 years. It's only a 2-year project. And I've adjusted the formulas for the 2 years all the way down. These only cover 3 cells. Now this could be a conference or a concert or something like that where the customers pay up front and then we are required to make our payments much later in time. But if you just look at this, you can tell it's the wrong solution. It is a solution that works, and this net present value proves that, but this is the wrong solution. If I receive $15,000 up front and I only have to pay out $12,000 over the next 2 years, I've got to have a positive internal rate of return. So this is one of the shortcomings of the IRR function. It does not work when you have a positive to begin with followed by negatives. And if you think this is an opportunity to steer Excel in the right direction by using that guess option, let me enter a 15% there. Think again, because that doesn't seem to have any effect on it at all. Project D is more similar to A and B, but we have a negative cash flow at the end. This might be a scenario where you're mining. You have to buy your land and your equipment, and then you extract minerals from the earth in the middle year, and then you have to restore the land back to original condition. So those kind of scenarios do exist, but let's see how internal rate of return does here. And that looks like a pretty reasonable answer, given that you would be up roughly 50% in the second year and then have to pay that down a little bit. This sounds like a reasonable answer, and it's obviously an answer that works because these came out to 0. Let's look at one more situation. Project E is kind of similar to Project D. You've got a cash outflow, inflow, and outflow. They're just a little bit different sized. They're kind of even. The net of these cash flows is only $1,000. So I would expect the internal rate of the return for this one to be near 0. And you can see it's found a solution at 42%. And this, again, is one of the problems with Excel's internal rate of return function. You're going from a negative to a positive to a negative, and it's throwing this off. In fact, look what happens when I change this just a little. We go from 42 to 64% for just that $1,000 more. So this is why internal rate of return is not such a reliable thing in Excel. It works very well in situations like this with one change in sign from negative to positive. Works great in those situations, but I wouldn't count on it in these other situations. You might get the right answer, you might not. There is another problem with internal rate of return. This is not an Excel problem, but a problem with the measure itself. Consider these two projects, A and B. They look pretty similar now. They have a similar internal rate of return, but I'm going to add 2 zeros to every number in this project B and scale that one up. And you can see the net present value using a 10% discount rate just got a lot bigger, and this is a much more profitable project than project A now. But if all you looked at was the internal rate of return for these two projects, you would not get a sense of the scale difference in these two projects. So keep that in mind whenever you use internal rate of return. The last thing I want to talk about in this video is called modified internal rate of return. This is a finance concept as well as an Excel function, and it's really a lot more like net present value than internal rate of return. It does return a percentage, however, like internal rate of return. And the thing that's nice about modified internal rate of return is that it returns the internal rate of return for a series of periodic cash flows, considering both the cost of the investment and the interest on reinvestment of cash. So you can enter in a separate rate for your borrowing and your reinvestment. In this case, I'm going to keep both at 12% just to see how far we drift from these numbers up here, which some of which we know are not valid. So let's enter our values. The finance rate will be 12% and 12% on the reinvestment rate. I would expect to get an answer that is identical to this IRR. And it looks like we did. Let's take those out to see how close they are. Very close. Now let's drag that over here. Now for these, I will re-enter since I only have 3 values, and we'll go with 12%. So I get an answer there on project C that seems a lot more reasonable, given the net of all cash flows with no discounting is $3,000, and the numbers involved here. That sounds like a reasonable answer. And I would say at first glance, these other answers look reasonable as well. So modified internal rate of return is another alternative to net present value analysis. What the logic inside modified IRR is doing in Excel is basically going to the list of cash flows. In this case, we only have 3. And it's going to discount this one to what it would be in this year, then combine those two values and keep repeating that process until there's only one change in sign. So it would only have to do one step in this set of cash flows. But it gets down to one change in sign, and then it runs essentially an IRR analysis on the remaining values. But you can kind of see how MIRR has strayed away from the spirit of IRR. IRR being a single rate at which all values are discounted, and it's the same rate that any positive values earn interest at. We're drifting pretty far away from that spirit with the MIRR function. We have our own finance rate and reinvestment rate, and we go through this process of combining and discounting cash flows to get down to one change in sign. So it's a useful tool as an alternative to net present value. I hope you found the content of this video interesting and informative and found it useful. Please consider hitting my subscribe button or at least giving me a thumbs up on the content. I'd also very much appreciate it if you leave a comment or question in the comments section, and I'll try to address those as soon as possible. Thanks for visiting Spreadsheet Geek.